Okay, here we go. Hey, we see some people coming in. We're just going to give everybody a couple minutes to join before we get started. Just a few more joiners. All righty. So good afternoon, everyone, and thank you for joining us today. My name is Jessie Peich, and I'm in marketing here at GamePro, and I have the wonderful job of taking care of you all today. Before we kick off, I want to mention that today's session is recorded, so I'll be sharing it with you all in the follow-up email in the next coming days. Now, let me introduce our speakers for today's webinar. Our first speaker is Philip de Veuser, who is GamePro's very own COO. He joined us back in 2021, and his main role consists of leading GamePro's research team of over 150 professionals across the globe. Prior to this, he spent his career in M&A and PE with Deutsche Bank, 3i, and Capvis. He holds a master's degree in international finance from HEC Paris. Also joining us in our webinar is our special guest, Sebastian de Bach, who is an investment director, a part of the CVC Benelux team based in Brussels. Prior to joining CVC, he worked in the European private equity team at Investcorp and in the Northern European M&A team at Deutsche Bank in London. Sebastian holds an MBA from INSEAD and a master's in business economics from KU Leuven. Today's webinar is particularly exciting as we have just released our newest report, the Europe 250, where we've analyzed and ranked the largest, most active investors on the continent. I'll be sending everybody a copy of this report in the follow-up email after the webinar, so make sure to keep an eye out for that. In just a moment, Philip will be touching on the details of this report, including some of its key findings, and you'll also be speaking with Sebastian about his views on the current investment and fundraising environment and what it takes to be a leading investor in Europe. If you have any questions throughout the webinar, we'll be hosting a Q&A session at the end, so feel free to write your questions in the chat. Now, without further ado, I'll pass the mic off to Philip.
Thanks, Jessie. It's truly an honor to present today the first ever industry ranking that we published. We've gathered a lot of interest for this webinar and received many registrations, so thanks for that, and thanks for the interest. We have a couple of slides to discuss. Thank you. Maybe the first page with the ranking. So CVC, without surprise, with Sebastian in the room, is a top pick, first on the list, with almost 60 billion assets under management according to our calculations. Also, CVC obviously has been very successful this year with a record fundraising of 26 billion. So definitely a correlation there. Other than that, the second place is for EQT, third place for KKR. Then looking at the top 10 in general, we see 4 names. Oh, maybe go back, Jessie. We see 4 names with a headquarter in Europe, 5 names with a headquarter in the US, and 1 with a headquarter in an APAC. Then over to the second page. So despite the presence of all of those mega funds, we still see that the European private equity industry remains highly fragmented. If you look at this macro chart, you see that there's many players active. We see a lot of local leaders dominating their own regions and having a very good returns and very local strategies. So there's a lot happening as well. So it's really quite interesting right now. Also looking forward, what's going to happen in the space. Also, we're going to touch upon consolidation a bit later as well. But it's really exciting to see what's going to happen in the next few years. Maybe over to the next slide. So when we look at the geographical split of the top 250, we see that the top pick again is in the US, second spot for Great Britain, number 3 for France, 4 Canada, and 5 Sweden. So when you look at these kind of countries and kind of the players active there, there's kind of 2 things we see. We either have geographies in here with kind of a mega fund. For a good example is obviously EQT in Sweden, or it's a country with a very strong mid-market. I think a good pick here is the Netherlands, with the absence of a mega fund. What also stands out when looking at this is the relatively low ranking of Germany. Despite the very large underlying economy, explanations for that is the absence of a mega fund, but also relatively speaking, a relatively small mid market and a high presence of family-owned businesses in the so-called Mittelstand. So that's something that we see in the underlying data, which we found quite interesting. Then over to the next page. So a couple of stats on our top 250. They manage 1.2 trillion in assets. They have raised 2.1 trillion over the last 5 years. The average the median EBITDA size in their portfolio is 43 million. And on average, they manage 28 companies in their portfolio. They have done 5,670 entries in the last 5 years and 2,130 exits. Then over to the next page. So, why did we do this ranking? When we were looking at the industry and whatever was published, we saw that there was a bit of a gap in the market around these kind of thought pieces. So most of the rankings out there, they're really only based on historical fundraising, and that has its limitations. So we really wanted to dive deeper in the geographical aspect, how these sponsors are investing and behaving. So to do that, you have to really dive in the underlying portfolio. Why? Because, the large funds, they typically raise a fund and it's hard to figure out beforehand where they will invest it, right? So a lot of the bigger funds, they might have a strategy with Europe in there or US or APAC, whatever, but a lot of them have not. So if you just base it on fundraising only, you're missing part of the data and you cannot really figure out where they're investing their funds. So what kind of sector, what geography. So this is kind of the idea behind it. We're also going to do more of these pieces, also looking at underlying countries and sectors. So that's yet to come. And as you might know or you might not know, we at GamePro have fantastic portfolio level data, as you can see here in the screenshot from the EQT portfolio, and we were able to kind of estimate the portfolio size of all of these investors in a very granular way, bottom up. So how did we do that? So we essentially looked at the number of portfolio companies they have, kind of the median EBITDA, and also a predicted EBITDA multiple that we have from our proprietary valuation algorithm, and that's how we come up with this. So now having said all of this and talked about the ranking, let's move to the core attention of today and CVC and our guest today, Sebastian. Welcome. So yeah, first of all, obviously, congrats on the #1 spot in our first edition.
Thank you.
The record-breaking fundraise as well of 26 billion. I think it's fantastic, astonishing feat in a difficult market, for sure. Maybe one of the most difficult years in recent past. So we're really delighted to have you on the call and also to discuss a couple of things related to the ranking, of course, but also to get your views on the market and your kind of sentiment trends and whatnot. But maybe let's talk a bit on the fundraising environment, and especially how was it for CVC to raise that latest 26 billion fund? What can you share about the process?
Yeah, sure. So yeah, I think first of all, before discussing some of the high level views, we have a dedicated investor relations team, and they deal with all aspects and the formal communication related to the fundraising. So all information I'm sharing today is a bit more high level, but I'm still trying to get a good sense to you guys about what's happening. So what I can say is that for the latest 26 billion fund that was just closed over the summer, and then the 22 billion fund that was closed during the first month of COVID, it only took us a few months to get all commitments in place, which is quite extraordinary, especially if you compare it to some of the competition, both the large cap space, but also the mid cap space, where sometimes this might take a year or a year and a half to get the funds closed already. So I think part of the fact why it went so fast is also the preparation phase. So earlier in my career, I was working for a mid-market fund based in London, whereby the frequency of raising a new fund was more like every 5 years versus every 2 to 3 years, which is what we see at CVC. And I think if you fundraise every 2 to 3 years, you often have the same teams of people doing the same process much more frequently. So they already know what questions the investors will ask, and they already know exactly the answers that they're looking for. Apart from that, also, the organization is managed quite professionally, both from a portfolio reporting perspective, but also from a communications perspective towards the investors. So once we decided to start fundraising, which is in the beginning of the year, we had our whole track records updated live already, and we did not need to go through, this sort of data collection phase of getting all your existing portfolio companies to report on the latest valuations and all those sorts of things. So yeah, that's it. And I think what happened also was maybe around performance, which helped a lot. So what happened over the past few years is that asset prices started increasing a lot, and then people started paying up for assets that fell within their investment criteria as they had funds to fill. And because of those high valuations that now fell, performance fell and started to go down for some of our peers, which made us top quartile. And then I think that just made the discussion a lot more easier. And then by staying disciplined on asset prices, I think some of the jokes that we're having at CVC is that CVC stands for cheap, very cheap, which is just, sort of the mindset that we have for every asset that we go after. We try to pay the right price. We try to not pay the price that we need in order to win the auction, which is something that people really started to think about over the last few years, because there were so many assets coming to market. But then for the high quality ones, everyone just wanted to own those because they thought historically they had performed quite well. And then if you pay up for the good assets, then if they start performing well, then you still manage to make a great returns. But if valuations go down and it's really on a multiple of 10 times, you're now paying 14 times. If that goes back to 10 times, then you just lose out on all your performance. So yeah, that's just some quick thoughts around sort of how fundraising happened, but also why it made it so successful.
Yeah, very impressive. And thanks for sharing those insights. Really, really kind of quite interesting. And I do recognize what you're saying around, having worked in private equity, about the distinction between deal team, fundraising team. I think it's something that we see. And, also looking at who's raising right now, those are the guys with a professional sales team, fundraising team, whatever you call it, right? That are really geared up and very focused. And often it's hard when maybe, the market is also not easy. So, attention from the deal team is maybe not always on fundraising and vice versa, right? So it is more difficult. I think the frequency, the professionalism of that team, that sure must help. I've never worked for a firm with such team, but I think that definitely makes sense. Now you're explaining it. Maybe then, looking ahead, curious to, kind of your outlook on the market, fundraising, what you're hearing from your kind of peers, colleagues, competition, whatnot, maybe other trends you're seeing.
Yeah, I think some of the trends that we're talking about most often in the market, and probably that happens at every single peer, is the financing markets. So what I would expect to see there, at least over the 12 or 18 months that are expected to come, it's, you have three components to the financing markets. Obviously, the first one is just the availability of financing in the first place. So that is starting to come back. So that's a good thing. but then you also have the pricing. So right now we're paying, almost 10%, 11 or 12% on the total financing package. If we're trying to generate returns of, 20%, then having financing that expensive is not helping. But on the other hand, we're also thinking about it in terms of, okay, if we get a loan out right now, maybe we can refinance in 2 or 3 years at normal rates again. So that's something that's happening. Obviously, the Euribor, where it's today at 3%, I'm not sure where that is going to head. But for the next 12 months, at least, I expect that to stay flat. We have the base rate, which is 5 to 6% right now. And then you have, another OID added on top, just to get your financing out in the market. And if you add all those elements, then yeah, you're above 10%. So let's see what's going to happen there. But right now, a lot of people are hesitant in doing certain deals just because of that. And because you talk about trends, and you've asked about some trends, I think another one that I can think about is probably consolidation, which is something that we've seen at some of the large cap US peers. Obviously, Blackstone, KKR, they have almost all the strategies out there that are existing in the markets. But also at CVC, what we're doing is we're expanding quite a bit outside of our normal core. So before the pitch was CVC, we're a pure buyout funds. And we're expected to stay that way. I think that was 10 years ago. Right now, what is happening is we've invested significantly into credits. We also have a secondaries business, which is the business that we've acquired. It was called Glendower Capital. It right now manages around 12 billion AUM. I think last week we've also announced an acquisition in the infrastructure PE space, DIF Capital Partners, 16 billion AUM. And we're starting to see that funds are growing inorganically as well, and we're seeing it at European peers. So consolidation is certainly something that is on top of mind. And then I think maybe last trend, because I've prepared this beforehand and just had 3 topics in mind, and I think hybrid strategies is something that is also coming up. We have a strategic opportunities fund at CVC, which is a fund that lasts 15 years instead of the standard 10 years. The holding period is 10 years versus 5 years in the flagship funds. Returns are more like 12 to 14% versus the standard 20% that you're seeing. And it's much more trying to figure out where different pockets of capital go to. And it's also listening to some of the companies that we're trying to acquire, what solution they're looking for. Maybe it's a family business, maybe it's a corporate, but they're trying to look for different solutions where you might want to acquire a minority. And before 10 years ago, when we were having a conversation with potential founders, and they asked, are you open to sell a minority stake? I think the answer was always, yes, they were open to it. But then for us, we were not really going into it too much because we only had a mandate to acquire majority. And then we could have certain governance rights, which we could not have in the minority stake. And I think some of our LPs are much more flexible and sort of giving us a mandate that is much more broadly. And you're seeing it at Apollo with their hybrid solutions that they're bringing to markets. You're seeing it at Blackstone with the tactical opportunities. And it's funny because none of the strategies are really similar, but they're after the same pockets of capital that are just looking for something different versus traditional flagship funds.
Yeah, it's also interesting you say that regarding these hybrid strategies. What we have seen as well is much more kind of aggressive maybe, or proactiveness from the credit funds, right? So it's probably in reaction to that, because they try to position themselves as alternative means of capital, also to family-owned businesses still, right? So kind of different way of providing capital, providing to their needs, and not always with a majority stake in the mix, right? Also, we at GamePro, we actually welcomed quite a few of these as customer, which is great for us, obviously. So, but that means that they're not relying on the buyout sponsor to come to them for their unitranche, whatever it is, but actually are going after the deals themselves before they come to market. So, which is kind of an interesting trend to see, obviously, but it shows a bit the kind of the last 2 years in the market. So maybe, what also is interesting, right? So, to get that almost 60 billion together that we have seen, right? Maybe around the deal-making environment. So, what has changed? How is it to do deals? How do you outcompete, other players in the market? Especially it's the upper mid-market. There's a lot of competition, from what I remember, obviously. But we also see, ourselves, it's a lot of kind of US headquartered funds that I was not aware of, active in the European markets, maybe because valuations are a bit more attractive, things like that. So, how do you guys, win a lot of deals essentially? So what can you tell about deal making?
Yeah, I think it's there's several aspects to it, and one is one that I've mentioned it already is, you come up with a much more broad offering of what are the pockets of capital that you can offer. So sometimes we might go to a meeting with 3 people, one from the flagship fund, one from credit fund, one from strategic opportunities funds, and it really depends on the type of opportunity, but also the mandate that we have to invest in, because obviously you have a Chinese wall between the credit business and between the flagship business. But on the other hand, if you're having a dialogue with a founder and you're trying to sort of get a relationship into place, then it's really good to just show that, we can offer different solutions for what you're looking for, because they might not have figured it out themselves. And what they want is they just want some breathing room, some extra financing, because they might want to acquire their biggest competitor in another geography. But they might not necessarily want to give up some governance. On the other hand, some of them are really looking for a strategic partner in the boards, some more professionalism. It might also be that the founder is just looking for a brand name behind them, and then CVC can offer that, because it just gives them much more credibility, something that they might look for when they go to the stock market, but they're just too small to do so, or they might not attract the right investor base. But yeah, that's some of the ways in which we win deals. And I think the fact that we're so local also helps, because we can just drive out with some of our different colleagues, or we can just exchange some thoughts quite early stage. Obviously, once we get to a deal stage, then we quite clearly separate the Chinese walls, and then once it becomes clear what the situation is. But in the early deal phase and in the mapping, it helps in having a sort of diversified offering.
Yeah, and you saw the list, right? It was not the first time you saw the top 10. What are your observations? Do you recognize the names? Are they the guys you compete with, or not? Maybe then would be an interesting observation. And then maybe some other things about CVC and its leadership position. How you get there. What are your thoughts around it? Working there.
Yeah. Looking at the lists, obviously not too many names are new in there, but obviously EQT, Permira, and Cinven, the other 3 European names, we encounter them a lot on different situations. EQT especially because they have the local office network as well, so they drive out to the companies. I think we're doing it a little bit more differently, where, from what I believe, when they want to own an asset, they spend a lot more time on it, and they make concentrated bets. Also, their average equity is a bit higher than ours. At least that's what we think. Sometimes the numbers tell us differently. We also like to think that they pay up a little bit higher for the assets that they want to own. For us, we're just scanning the whole market, and we have a fiduciary duty to look at every asset. They look much more thematically at certain businesses. We are looking more at sort of the management teams, and then the sector comes second. Something else is that obviously Ardian and Advent are not in there, which we see them as often as the names that I've mentioned before. BlackRock and GIC, quite applicable. Something that didn't happen 10 years ago, but when we do very big deals, at some point we get to a maximum equity tickets, which for us is, once we get to above 1 billion, it's hard to convince GIC to be more concentrated within that single asset. So then we come up with a list of co-investors, and GIC and BlackRock are quite active in doing that. So probably that's why they're in the lists. Yeah, but they also have direct investment teams, so it's probably a mix of several elements. So yeah.
Okay. And anything else? So if you compare to kind of the way the deals happen, how CVC has kind of that branch of offices. Can you tell a bit more about that? How's that different to some of the other guys?
Yeah. I think a good example is probably also, so Cinven is someone who, they have an office in London, they might have one in Frankfurt, but they're much more concentrated, and then especially Blackstone. So Blackstone has one office in London. They just opened one in Frankfurt, I believe, but they're looking much more holistically at Europe as a whole. So they don't have the local country teams looking at one single country. And I think what we are doing at CVC is, we know local politics, we know the local entrepreneurship, and entrepreneur environment, and those types of things, and we have 16 offices in Europe alone. So whenever we call a different country, they know exactly the type of business already from name, just because if it's a brand name or something else. But yeah, I think for us, we have the local office network, which helps a lot. And globally, we have 25 offices. So if you think about the fund being 26 billion, 25 offices, that's 1 billion of equity per office that we need to deploy. And then if we have the velocity of every 2 or 3 years, new fund coming in, then we need to deploy 500 billion every single year. So which is much more digestible if you compare it to 25 billion fund that would only be managed from London.
Yeah. And how is it with kind of internal competition? You're mentioning kind of 1 billion per office, right? So obviously that probably is not the case in reality, right? So some companies are a bit bigger or some teams are better, whatever, you don't have to go into too much detail, but does that help or does that limit, or how do you see that?
Yeah, I think internal competition is something that at least the press writes about a lot. And it does happen because some of the businesses, once they grow to a certain size, they might have their headquarters in the Netherlands, but most of the operations in Germany, and then they want to expand into the US. So the angle is quite, multiverse, and then you have different teams who might go after the assets. In reality, I think we just joined forces because there's always a legacy that is important to know where the company is coming from. So yeah, then we just join deal teams, and then the deal teams might start to become a little bit bigger, but still we try to limit it to 8 to 10 people in total. So I think internal competition is sometimes happening, but at the same time, it's figured out between the managing partners quite quickly.
Yeah, one team, one dream. Well, that's great. Thanks for all of that, right? So also looking at the time, and we have a lot of Q&A coming in. Maybe back to Jesse for a couple of select questions.
Yeah, absolutely. Thank you for that. Now we have a number of questions that came in throughout the webinar, so we'll take a look at that. The first question is for you, Sebastian. It reads, CVC obviously invests sector agnostic. Can you still elaborate which sectors you personally find attractive in the current market environment?
Yeah, I think in terms of sectors, we're not bound by any specific sectors. We do have, 4 industry teams which are based in London. So that's a sports and media team, it's a technology team, a healthcare team, and then a 4th team that I'm missing right now. But I think what is happening there is that we try to have a presence within the sectors that will continue to perform well. And then whenever we have a new sort of industry vertical that we think is interesting, we try to add some expertise. But it's not like we have a certain mandate that every single year we need to invest X equity in a certain sector. Sports and media is an interesting one at CVC because we've done a few deals in the sector, and then because of the fact that the expertise started to be built, then we build a formal sector around it, and it really helps. I think one of the deals that we've done is La Ligue in France, La Liga also in Spain, the Women's Tennis Association. We also did Formula 1 in the past, and once you build a certain credibility in the sector, it helps. And so yeah, then it depends on how we build our expertise. But if you ask me what sectors I find interesting, I think what I've seen at CVC since I've started there is that there's so many different subsectors in which we don't have expertise, but because of the fact that there's one business that might be built in Germany, the same sector also exists in Belgium or in Spain or in Italy. And then once a certain deal hits markets, then we just already know what's happening in there. And I think there's so many different subsectors that I'm thinking about. It could be sort of a testing and inspection business, which is something more straightforward and popular. It could be chemical distribution. It could be sort of a maintenance or servicing business, could be payroll business. And some of those things are much more local. So we try to have the industry expertise across geographies, but not a specific sort of, let's say, mandate, an obligation to invest within one. So it's a bit more of a harder question to answer, but I see where they're coming from.
Some good perks if you do Formula 1 as a deal, huh? I guess on the side. But
yeah, well, I have not been part of the deal team, but it's a good sort of showcase, and it's a good sort of, I wouldn't call it the trophy asset, because trophy assets sometimes come with the fact that people overpaid for it and then they hold on to it too long. But I think it's a deal that has put us on the map alongside a few others that we have done equally successfully, but are just less top of mind for some people.
Awesome, thank you. So the next question we have is for you, Philip. It says, it is interesting to see the high ranking of the US HQ large cap funds. What is the difference in modus operandi and how are they so successful deploying so much cash in Europe?
All right, thank you. Yeah, I think we already went into a little bit of that, I think, during the conversation, but I can add to that for sure. So I think it's the opposite of what Sebastian described for CVC, with that the huge kind of network of offices, local relationships, and all of that. I think they also position on slightly different deals. So really the large tickets, anywhere starting from 500 million up to multi-billion. So really to kind of get to that deployment rate and also deployment size, because they typically hold somewhat larger funds as well. So typically very centralized large teams sitting in London, or maybe one additional location instead of 15. That's what you typically see. Typically also working on already private equity owned deals, so they are kind of easier to source, and they will be intermediated by the largest bank. So it would be your Goldman, JPM, MS, coming to you with those opportunities. You can really prepare well for them with a large team, and try to win them. Indeed, I think it's maybe a bit more transactional, so you don't have to build up rapport with a family over years, visit them multiple times, like in the mid-market, larger mid-market. What is quite kind of usual there, because competition is so intense, and there's a lot of kind of mid-market funds after the same assets. So I think that way of working is just very different, and that works pretty well for large deals. So you can fill up large funds and deploy a lot of cash in Europe. I think that's the underlying. I think if you look at the European funds and how they have grown, it's all very similar to what Sebastian is describing. In the end of the day, I don't think there's any one that's very centralized in the end of the day. So they have smaller teams doing local deals that are maybe somewhat smaller. So I think that it's really kind of a different way of working in the end of the day. I don't know, Sebastian, if you agree with me, or is that something you recognize?
Yeah, no, I fully agree with it and totally recognize it. Yes.
Yeah. So also larger deal teams typically, right? So everybody's doing a specific part of due diligence, and really kind of process machines in the end of the day. Really making sure that they maximize their transaction certainty in the end of the day, I would say, because there's not so many of those large tickets or deals coming every year. It's just a number of deals. And again, what I also see is actually, which is quite funny, is that a lot of these American funds, they invest in regions where we don't see so much interest from other European investors. So let's say Italy, Spain, a bit more interest there, because there's also large companies there, obviously, right? So they're pretty agnostic in terms of where they look. So it's not only Germany, UK, Benelux, Nordics. It's very also see a lot of interest there, Spain, Italy. Yeah.
Great, thank you. Now we have one more question here. It says, we can also see a significant inventory of unexited portfolio companies. To what extent will that influence valuations across sectors?
I can take that one. So yeah, it's very interesting because there's a lot of portfolio companies right now in the hands of private equity, and because of the current environment, people are just a bit more hesitant to exit, because they think they might not get the same valuation as they might have gotten last year, or what they would expect to get maybe next year. So what people are doing is they're just holding on to their assets for a bit more longer. Obviously, if you do that, then your returns will start to go down. So you need to generate a new investment case again. And people are really starting to open up some of the larger transformational M&A again in your year 4 or 5 of the holding periods, which is something that people would never do before. Sometimes you would do a deal, and then after 2 years, you do something transformational. It takes you another 2 years to integrate, and then you have a good exit. Right now, people do that after year 4 or 5, and they might even deploy the same amount of capital that they did in the initial deal. And then it becomes a whole new investment case. I think that's something that's, again, at CVC, we're doing a lot right now. So if I look at the investment committee agenda, there's really a lot of things coming to markets of exactly that case. It also gives us, because of the fact that there's less deals in the markets, we have a bit more time to spend on difficult transactions. So let's say large carve-outs from corporates that might be added onto our existing platforms, we have 6 to 9 months to do the deal. And then if you get them at an attractive valuation, then you generate the same return as you would do from doing a normal buyouts. So yeah, a lot of stuff that is happening there. But then again, yes, at some point there will be a wave of exits, and let's see what happens then. Because people only have so much time at their hands, and then let's see what happens with valuations, but also capacity of the teams. So interesting times to come.
Yeah, I think maybe adding to that. So in the end of the day, the market multiple is not going to go up in the coming years. I think people are looking for different ways to build out value. Could be internationalization a bit earlier for the smaller investors, but definitely what we see is a lot more interest and in add-ons. So this became like one of the key reasons, for example, to look at our platform versus number 2, 3, whatever it was in the past. This is really top of agenda, and not particularly typically your add-on shops that are known for doing add-ons. Actually, everybody's asking. So how do we do it? How can we actually build out a portfolio? So way more than kind of 2 years ago, to be honest. So I think this is one thing. Obviously, not sure if the continuation vehicles is still a thing. I think there's a bit of mixed signals from LPs, how much they like it, but we still see some coming through. Actually, right over the past few weeks, there were a couple of continuation vehicles raised. That's one thing, obviously. One solution for it, but not the holy grail, I guess. And maybe a bit more money multiple focus versus IRR. I don't know. Like, do you have any kind of context on it? Is that shifting a bit towards that as a metric, or still IRR king?
I think it really depends on sort of the let's say heritage of the funds. So some funds are rewarded in their carry deal structure based on money multiples, and then people just really stick to that. Other people are more based on IRR, and then there's a lot of people in between. I think on continuation vehicles, it's an interesting one, because before, people, when they needed to sell an asset, they just sold it on to the next flagship funds. But then you really have sort of this conflict of interest, because you might have some of the same investors in there, and then you have also new investors. So if you sell at a price that is too low, it's not fair for the existing investors, and then it's a good deal for the new ones. If you have exactly the same investors, then it's a much more straightforward case. So sometimes what you try to do is, out of one specific fund, you get a continuation vehicle, and you go on with the investors that were on board already, and then you basically onboard that asset into the continuation vehicle. So the conversation becomes a bit more easier. But again, I don't think people have figured it out totally what to do with those. Again, what is also happening is something that I've mentioned with our strategic opportunities funds. People are just extending the life cycle of a fund. And then instead of raising something in 10 years, you have the option to keep it for 15 years, but then it's much more of a mess when you ask for extensions with investors. So I don't think the perfect answer has been found yet.
Yeah, time will tell. I don't think we have a crystal ball, unfortunately. It would be nice, but it's a lot of things happening, obviously.
Yeah, and the secondaries market is also helping a lot in that, and that's something that we're doing in Glendower. Just spin off one specific asset, and then you found new investors, or there's all types of possible solutions that you can look for in the market. And there's a lot of people that are being paid significant fees, like advisors, to come up with a solution. So I think we'll be okay.
Well, back to you, Jesse.
Awesome. Thank you, guys. So that's all the time we've left for the Q&A session. So if we didn't get to your question, we'll try to answer it for you in the follow-up email. So I'd like to thank everyone for joining us today, and I hope this was a great session. In the next coming months, we have even more GainPro events and webinars, so stay tuned for those, because we'd love to see you all there again. Well, until next time, that's it for today. See you, everybody.
Thank you. Bye-bye.
Thank you very much. Bye, everyone.